Leads naturally into the next slide of our potential. As we've been talking for 10 to 12 years, the consumer is coming our way. 90% of all banking consumers today conduct at least one electronic transaction per month. In-branch banking is starting to become less and less popular. As we talked many years ago, the big institutions are just great educational services for us in teaching the consumer on how to do the electronic banking and getting them out of that brick and mortar play. This chart's a little tough to decipher. 2002 to the left, 2011. In the past 9 years, total transactions have grown geometrically. That's the green bar. The average consumer would do 16 transactions per month with their bank. They're now doing almost 38 or close to 40 transactions a month. Historically, in 2002, the blue line of those transactions, 5 of them, or 1 out of 3, were performed at the branch. And the red was the electronic, was the balance of the transactions. It's now flipped geometrically the other way. They're now doing about 3 transactions at the branch, and they're doing close to 30 transactions electronically. So if you think about it, you're using a debit card, you're using an ATM card, you're doing it online, in the bank and the text messaging, you can check your balance before you make a purchase with a debit card to make sure you have the money available to you. So it really truly is, the market is moving our way in product delivery. And as the banks continue to try and cover the overhead of all the branches they built to help the consumers in the old-fashioned way, it makes our model even better and more effective. The operating model, as we talked in the beginning, we don't match up well with our peers on the net interest margin because we're putting the funds back to the consumer. But one area we've shined over the years is leveraging our operational expenses. We've stayed consistently almost 100 basis points below our peers, and we operate much, much more effectively. And as I stated a couple times already, we've made all the big ticket expenditures that we needed to do in upgrading computer systems, adding the management teams and the business process internally. We've literally locked in our fixed costs, and we're in a position to double down on the balance sheet without significant internal expenditures. Our overhead and asset ratio will only continue to improve with time because we're locked in. As the assets get bigger, that number will get smaller on our side and look even better according to our peers. This carries over into the efficiency ratio, which is a big one that the regulators look at. How effectively are you running the organization with the bodies that you have? Again, we continue to better our peers, and that number should get better with time. Again, with the commercial lending, once it kicks in and we actually get those assets on the balance sheet, our team of 5 can do a tremendous amount of business, which will have a very, very positive effect on this number. So hopefully the low efficiency ratio will only get better with time. Leads us into the First Internet Bank share price and the upside potential. As of March 31st, we are trading at about 45% of our actual tangible book value. Not unprecedented, particularly here in the Midwest. We're a little bit guilt by associations. The average community bank here in the Midwest is trading somewhere in that 50 to 55% of book value. So we're not totally beat up according to our peers, and some of it is just guilt by association. Technically, with our financial performance last year, the capital levels we have in the bank, the credit quality and the management capacity and capabilities, we should have a better number than this. We debate, believe me, internally virtually every staff meeting on what's going on and why are we in this position. Obviously, one of our greatest restrictions compared to most bank peers, we weren't classified as a public company. So when you would look at banks in the Midwest, because we're traded on the bulletin board, we showed up on none of the sheets. That's changing. Most of the analysts and folks covering banks here in the Midwest now, we're starting to pop up on their sheets. So bulletin board does make liquidity tough to get. Our volume is, I'll show you a chart in a second, has picked up tremendously, but we're still in averages of hundreds of shares a day versus thousands. Net interest margin is just one of the key parameters that folks look at if they don't get the full story of what First Internet Bank is all about. Our margin is lower than our peers, but they don't take a look at the operating expense and the other issues, so that gets to be just when you look at that first big indicator, which historically showed as a good bank, it was north of 4% on margins. But again, they're down in the 3s, so we're up into the 3s, so that is waning and should hopefully come back in our direction. Bottom line right now, in the financial community as a whole, banks are an unpopular investment choice for consumers. They feel that they took advantage of the consumers over the last couple of years. They just kind of have a black eye, and that's just going to take time to rectify itself. Here's the share price and trading volume report of ours. Good part about it is our volume is picking up without question, and we're getting more and more activity, particularly since the first of the year. So it's coming in our direction. If I could sit up here and tell you, we were trading at the end of March at close to $11.50, $11.60 a share. We had an uptick today. I think we're another 4,000 shares traded today. We're at $10.75. We're getting back up to that number, and we could sit here and say, oh, we're ecstatic. We're up almost 200% over the course of the past year. We're really happy with the share price. The reality is we're not. Our book value is closer to $27 a share, and that's really what we need to get it up to and what we're working on. So although we've made a significant move, if you look to our peers over the past year and moving the number up, we still have a long ways to go in just to get up to the book value. Kind of, again, comparison to show you where we're at to market. But bottom line, come up to April, we've gotten back in sync with our peers. The blue line through here, obviously, is the First Internet Bank stock, and the others are indexes that follow community bank stocks. So we're back up and kind of running along with our peers. We've got a ways to go to get to where we want to be, but at least we're back in the market swing.